Welcome back to Morning Trade Live. Before North Korea and before the news on AT&T Time Warner, we got to talk about the macro story because that now becomes the biggest driver for markets, at least as we await the Fed. Or does it? I want to bring in Bob Iaccino. He's the founder and chief strategist at Path Trading Partners, as well as Kevin Hanks rejoining us from Omaha. All right, Bob, so is this the story of the week now that we got these other two big items removed? Is it time to get hyper obsessed with the Fed?
Hyper obsessed. And I think Kevin would agree, because we talked about this last week, that this was kind of summit week coming up, and the first summit's out of the way and the market shrugged. Markets didn't care, nor should anyone care, given the sort of broad-based agreement. I mean, it's definitely gets a check in the positive column for the globe. I think there's no disputing that. But from a market perspective, these are the two summits we're looking for. And by two, I mean the Fed and the ECB. Fed being today, the second press conference for Jay Powell. We'll see if he learned anything from the first. I don't think there was really anything to learn, although he did learn that the word overheating matters, right? Yeah. I mean, as soon as everybody just focused on that in the last statement. So I think that's a big part of it. How do they reword the statement? I think there'll be some not so slight changes in the press conference, but mild to no changes in the statement.
All right, so Kevin, for what matters to markets, do you look at the 10-year, which has not crossed 3% since the Italy situation pushed it back down to 2.7 handles, or is this more about what happens to the U.S. dollar, given we've got ECB later on? There's got to be some volatility somewhere here, Kev, right?
Well, I'll tell you what, Oliver, I don't believe, unless Jerome Powell, great comment, Bob, by the way, unless Jerome Powell come out and doesn't learn anything from his first press conference, where he was a little more hawkish than I think the street would have liked. He's not. Is he going to cause these markets to move? And then the next question is Mario Draghi going to cause these markets to move? Now, Mario Draghi, he's a little more, there's a little bigger of a chance that he likes to make a headline coming out of his meeting, right? So I'm much more interested in what Mario Draghi is going to say than Jerome Powell, because I think he'll learn his lesson. He'll be a little more dovish and a little more measured in some of his comments moving forward. If he doesn't, bonds will move off that.
Now, Bob, for you as a trader, where do you see the most potential for moves happening today? You knew I was coming to you with this, Bob, because let's find some volatility in this market right now.
Yeah, I unfortunately don't necessarily think it's going to happen today. I both agree with Kevin, and I want to add a little. It's going to be a Kevin Hanks, Bob Iaccino love fest here. I think what's going to happen is we're going to get very little out of the Fed. I've mentioned this to you guys before. We had 2.8% year over year. That's the hottest inflation in 6 years. Jerome Powell said overheating in the statement, or in his press conference, in his statement, and then Fed speakers prior to that have said, or prior to this meeting rather, have kind of dialed that back, saying we might let inflation run a little hot. So hot versus overheating. I think it's going to be a mild Fed statement and a pretty relaxed press conference. And then Mario Draghi, I think, likes to make headlines in terms of confusing the headlines. In other words, to me, and I can say this because my last name ends in a vowel, he's a classic Italian where he's going to talk both sides and make sure he's right in the end. I think he's going to do this thing where he says, you know, we should be targeting an end of QE, but if you look at the data coming out of the EU, it has been underwhelming at best lately. It has not been weak. It has not been strong. It's been sort of a baby bear Eurozone. And again, the ECB has always talked about waiting for inflation. That's the thing. I wonder if they're going to change that. I wonder if they're going to take the Fed's model and say, we think normalization now instead of waiting for inflation, because they don't have inflation yet. So that'll be the headline I'd be looking for. I think the biggest move we're going to see is Euro USD.
So this is bringing me then to a point that, you know, a place I love to go, Kevin, which is that relationship with the currencies around the world and the U.S. dollar. If this has been the reason for the dollar strength, that central bank divergence, the economic data divergence, the surprise indexes, all that stuff, Kevin, if that changes, does it have ripple effects into the broader market? Does it have ripple effects into growth companies driving equities and things like that? Talking emerging market weakness as well. I mean, this ties into what I think has really been the consensus trade in 2018.
Oliver, we're in the final weeks of the second quarter. So we're about to start. We're about 3 weeks away from the start of second quarter earnings season. And coming to an earnings report near you, Oliver, is going to see currency headwinds. You're going to start to see this higher dollar, the move from 88 to 93 up towards 94. This is going to start, it may start creeping into earnings and their guidance, currency headwinds. You may hear that in some of the reports coming out of next quarter's or this quarter's earnings report. So,
sure.
I think what could happen, the biggest movement out of this whole 3-day, 36-hour open, FOMC and ECB and Bank of Japan could be the dollar-euro relationship. I don't think that's the only one that I think really has a chance to move here, unless, of course, Jerome Powell makes a statement that some people construe as hawkish or overly dovish. Could move the markets. I don't think he'll do that. I think he'll take a page out of Janet Yellen's book and kind of go back and forth with dovish and hawkish. That always seemed to take volatility out of the market. It's Mario Draghi, though, that's going to make the waves, I think.
All right, Kevin, when we talk about the dollar, Bob is bringing up the earnings that are on the way and the frequency of CEOs to look for something to blame if it stays high. But Bob, I think you and I have talked about this logic before as well. My question is, if the central bank story comes together and Eurozone starts to sound hawkish, if Draghi gets more hawkish and suddenly we're back to this, synchronized hikes and synchronized growth, does it mean that equities then experience a February type event where investors and portfolio managers maybe think, all right, maybe I'm not going to chase growth the way I was. Maybe this is actually going to finally take shape and I can go into some other assets that will give me yield?
Yeah, I think that could happen, and I kind of want to play off of what Kevin said a little bit here, because I think no matter what we're talking about with these two summits, these two events, the FOMC and the ECB, we have to pay attention to the dollar and the recent relationship that we've seen with the dollar and the Russell. Yeah. So the one thing that Jerome Powell can't control is the dot plots, right? He can spin the statement, he can answer questions in a certain way in the press conference, but the dot plots are the dot plots. And if you see more hawkishness in the dot plots, you see the dollar rally, you see the Russell rally, which has been that relationship lately. And to your point, that kind of does a little bit of what you're saying. That's why we're looking at stocks now like SunTrust, PacWest, some of the smaller financials that can benefit from that kind of a move. And then you're relying on Mario Draghi to not surprise, because he's expected to be hawkish. And again, agreeing with Kevin, I don't think he's going to be that hawkish, because that's the surprise. I think he's going to balance it out. So outside of the euro-US dollar, I want to look at the Russell and some of the smaller financials as the specifics of what we're going to look at going into these two meetings. So long answer that diverted from your question, yes.
Yeah. That's right, Bob, because you've got the small caps, which fall into that story as well. As you mentioned, the financials there too. So, Kevin, there is basically a few items that we know have strengthened because of, or rather probably because of, this sort of dovish outlook that has remained there in 2018 despite all the expectations coming into this year. So then if it changes, what? Do we finally get that financial leadership? Do we finally get the next leg lower for the utilities and things who've been holding on for the ride for 2 months, just basically flatlining, waiting for an answer?
That's a good point, Oliver, because the banks and financials have really struggled here to get that next leg up. And, that's the gajillion-dollar question in this market right now, Oliver. If we have another leg up, who leads? Right? Is it the financials? Is it the industrials? Or is it NASDAQ and the FANG stocks? So that's the question. I really think that I personally am really watching financials, Oliver, and bank stocks. That's where I think there's a chance for another leg up in this market that could be the leadership because of, slowly but surely increasing interest rates, the net interest margins, as long as trading revenues keep up. Right, because I think that's the first quarter that had where they had problems in the first quarter, or I'm sorry, the fourth quarter of last year. First quarter looked a little better. I'm very interested to see in 3 weeks what comes of the financials earnings and how they do in how the trading profits or trading revenues kept up in the second quarter.
One last point, Bob, before I let you go here, is the market underpricing some surprise risk, because it is quiet as quiet gets this morning, Bob. When I look at the 10-year doing nothing, stocks not doing much, even though we had that big bid around Italy, bonds here don't seem to be too concerned.
Yeah, and the curve flattened a little bit too. So I think the dot plot risk is the thing that we need to be looking at. And then secondary to that, you know, Kevin mentioned FANG, and I'm going to steal Fan Mag from Pim Fox. I think, Oliver, you know Pim as well.
Yeah.
He calls it Fan Mag, which I like, which is Facebook, Apple, Netflix, Microsoft, Amazon, Google. I think it's more accurate. Those companies have about 4% of global market cap. If we get weakness in those companies for some reason, it'll pull everything down except the Russell. And I think that's the risk that I'm most nervous about, what happens with those particular 6 names. That is a very, very big portion. It's almost $1 trillion, it's over $1 trillion in market cap. Those have enough strength to pull the market down, but not necessarily drag the market back up.
Yep.
So we have to look at these dot plots, because if they get more aggressive, it could affect those stocks.
Point well made, Bob. And the N in that acronym from Mr. Fox, Netflix is just laughing in the face of the AT&T Time Warner deal, up 2.2% as we speak. Guys, we got to leave it there. Awesome stuff, Bob. Appreciate you jumping on to help us preview this big event this afternoon and later on this week. Bob Iaccino is the founder and chief strategist of Path Trading Partners, and Kevin Hanks in Omaha at the TD Ameritrade headquarters. Coming up next.